Hey, it's Mitchell J, the Scaredy Cat Guide, and I just wanted to quickly show you how to use the online rental property calculator if you have not been using it, or if you have, maybe you had a couple questions. So I'm going to show you how I use it and some of the default percentages, why they're there, and why I suggest them. So first things first, we will put in our access code, and that will bring up the property calculator. Okay, so looking at the calculator, you will see we have our input cells are in yellow, and some of them are pre-filled. You see the percentage down, uh, amortization, vacancy. You see I have numbers in there for maintenance, reserves. So as we get to them, I'll explain why I suggest those percentages, or just have them there as a default. So if you saw the thumbnail for this video, you saw the price point of my example is a property going for $190,000, which ironically is something I've looked at recently. I was in the Carolinas and I looked at homes in the 180 to 200 price range. So generally when I buy properties, I do put 20% down if I have the money to do so for a couple of reasons. One, I hate paying PMI, and two, I like having some equity to start. I like having a cushion, but that's just my personal preference. So 20% down is, the traditional down payment. Obviously, you can adjust this number. If you're doing an FHA loan, you can do 3.5%. Obviously, if you're not putting any money down, you're buying cash, then you just do 100%, and that will update the calculator accordingly. So in this example, 20%. Repairs, most of the stuff I was looking at was pretty rent ready, but if there's some updates I want to do, so let's say I'm factoring 5,000 in my example. Interest rate right now, we're looking at about 5.5% on investment loans. I'm going to do a 30-year loan. So now we get into the section. So that gives us our payment, which is $863 a month for the mortgage. And now we get into the revenue and cost section, which is basically the rents we'll be bringing in. And for the area I was looking at for 3-bedroom, 2-bath homes, the rents were anywhere from 1,900 to 2,100. I like to play it conservative, hence being the Scaredy Cat Guide. So I'm going to go with 1950. So I know I should definitely be able to get that since it's towards the lower end. Obviously, number of units is just one because it's a single family home. Vacancy percentage. You need to factor in vacancy. It's great when a tenant stays and renews, but you're going to have turnover. Hopefully it won't be every year, but I like to factor a month's vacancy so I know that if it does happen, I can still turn a profit. Some people are a little more aggressive and they only factor a half months. Me, I like to play conservative and know that my numbers make sense even with that. So that's why I have this percentage in here by default for vacancy that equals 1 month's rent. You can adjust that as you see fit. Annual taxes. This is pretty simple. Go to the county's appraiser website, look what the taxes are for the given property you are checking out, and then plug it in. In my example, the taxes were $3,100 per year. As for insurance, I've talked about this before. Just call your local insurance guy, tell them you're looking at XYZ property and get a quote. In the case of the property in my example, we're looking at about $2,000 to insure it. So then we have management percentage. I plan on self-managing in the instance of this example, but standard management charges about 10%. If you have multiple properties, sometimes you can negotiate to 8%, but generally market rate is 10% of rents. So in this case, it's 0. Maintenance percentage. You need to factor in dollars for maintenance costs. Things are going to come up. You're going to have whatever it is, leaky toilet, broken faucet, you name it. I factor in 5%. Generally, as long as your rents are above $1,000 a month, 5% usually is good enough and covers your typical maintenance costs. And these are your smaller items, like I said, like, leaky faucet or, issue with the toilet, things like that. Utilities and HOA. If you are paying the utilities, if you're supplying the utilities, then you want to factor in these costs. If you're in a homeowners association, then you need to also include that cost. In my example, it is a three-bedroom home, single-family home, not in an HOA, and obviously the tenants are going to take care of the utilities. So I will leave that as zero. Reserves. Reserves are for your CapEx items. So if you need to replace a roof or an HVAC unit, things like that, you need to start allocating money for that so you don't have a big four or $5,000 expense or $10,000 expense in one given year, and then it blows up your financials for the next couple of years. So you should be factoring money towards that. So I factor in 5%, so I'm able to essentially stack money every year so that when that cost happens, when it occurs, I've already got the money allocated and it's not crushing my bottom line or impacting my cash flow. So those are the numbers that I personally like to roll with. You can cater them to your needs and to your desires and to your goals. So with that said, now we've gotten our numbers. Everything fills in, annualized rent, 23,400, allocation for maintenance, allocation for reserves. So after we do all this, we get our operating expenses. So you see what our operating expenses are, which is on this example about 40%, which is pretty good. It's pretty low. Usually you're going to see they bounce between 40 and 50%. So that gives us our net operating income, which is about 14,000, and then less the debt service, which obviously, got to pay the loan, and that gives us our cash flow. So our annual cash flow, and then cap rate, and then cash on cash return, and our monthly cash flow. So these right here are more so used in commercial and bigger multi-units. This is the debt service ratio, and then the cap rate is something that's used more in commercial investing and commercial real estate. Really, my main target is the cash on cash return percentage. I personally want to get at least 8% on my money or better. Some people want more than that. But anytime I can factor in those costs that I'm allocating for and still generate 8% or better, I'm happy. So in this instance, this property does meet my goal, and it throws off about $300 of cash flow a month. And that's, like I said, even with allocating vacancy and reserves and maintenance. So it's a beautiful thing, because if you have someone renew and you don't use that vacancy number, boom, that goes right to your bottom line. So that's why I like to find properties that will throw off cash flow, factoring in these expected costs that will pop up at some point. But that's it. I just wanted to show you how to use the property calculator real quick. Feel free to jump on the website. I have plenty of blog posts talking more about investing in real estate and things that I found that work and don't work. And then, of course, there's always the book, which you can find on my website or on Amazon. That's basically a step-by-step guide to investing in rental properties. So I will see you out there, and good luck with your investing, and be sure to buy right.